the Federal Reserve does not have control over medium-term rates.
Okay.
Okay, the most important rate in the economy, by far, is the rate on the 10-year Treasury yield.
Mm-hmm.
Hey everyone, welcome to Fundamentals Unfiltered, the weekly podcast from the Fundamentals Investing Institute. I am Matt.
I'm Louie.
We are going to be talking about business ownership, and we are going to be talking about Kevin Warsh, the new Fed chief, and some of the changes that he's making and what that means for investors and business owners and anyone else who is exposed to credit markets. This episode is brought to you by the Fundamental Investing Foundations course from the Fundamental Investing Institute. Visit FIIlearn.com to learn more. Now, Louie, this is our first podcast, and I have been spending a lot of time thinking about what can we talk about that is the most foundational, that is really something that we can build further podcasts off of. And something that came to my mind, I guess maybe last week or so, was the concept of business ownership, really kind of in the most abstract way. So what I thought about was, Warren Buffett, when he is talking about managers and he's complimenting managers, he always says the highest compliment he can give to a manager is that they think like an owner. Now, what's implied by that comment is that most managers don't think like owners. And we can go into this a little bit because, to use some kind of business school jargon, this is a reference to what we call agency costs. Basically, a lot of corporate managers are incentivized in a way that's very different from the best interest of corporate shareholders. But really what I want to focus on is this notion that Warren Buffett has of business ownership. Obviously, he has some kind of nominal ideal of what business ownership is. Now, why I've thought about this is because in our experience, both you and I have very substantial experience in the small business world, and I've really had another foot in the door into public capital markets. And in both cases, there is a huge gap between actual behavior and this nominal ideal of business ownership. So let me just say, maybe we can bounce off each other a little bit, but my view of business ownership, again, this kind of nominal ideal, is that business ownership is really about long-term value creation. So we're thinking about how do we enhance the value of a business, not in a quarter or a year, but over the long term. And in the small business world, one of the things that's lacking a lot of times are things like standard operating procedures. Basically, in the small business world, most businesses are jobs. They're not businesses, right? So
Yep, absolutely.
we've seen this firsthand because in a lot of ways, my father's business, which we essentially had to liquidate for substantially less than what that business should have been sold for. You had a similar family story with your father's business where he went from a very big, enterprise to really having to liquidate it again. So we've both have a lot of personal experience with this, but let's talk about on kind of the small business side. Where do you think most small business owners, they trip over their own feet, as it were, when they're running their business day to day and not thinking about that business as distinct from themselves?
So I definitely think that this is very important, right? As a small business owner, we tend to start out as a employee for somebody and say, I can do this myself, and not really understand what it takes to run the business. And you had brought up a great point about small business owners tend to start thinking in that sort of sense, the fast, quick way to make their living, and not look at the big scale of things, the bigger scale of things as, what is their exit plan when they grow, how to actually build this business, and what they need to do to make that business run without them there, so they can, because let's face it, we all have the dreams of starting a business and we think it's going to be financial freedom, and
Right
then
off the bat.
yeah,
Right off the bat.
and we forget that it's the complete opposite. We are, working harder than we ever had for less money. We're trying to get employees to understand our passion. You're going from a person that uh, maybe only had to manage themselves to maybe now managing other people.
Yeah, and
Um,
those soft skills are incredibly hard. I mean, that's the stuff you're never going to learn in a university or in a professional training course. You just have to get in and
yeah,
get your rear end handed to you every so often.
exactly. And and that's the thing too. Every day you get kicked in the the balls, but we just got to keep moving forward and keep that passion going, and how to make those SOPs work, the standard operating procedures, how to create those that really give us the opportunity to make things run and run as a well-oiled machine. Warren Buffett has mastered the art of this. And I think that we can learn a lot from him. And there's plenty of other uh, institutional leaders out there that have mastered this. And what can we take away? And hopefully, Matt, with as we keep growing, some of our knowledge people can take away, our what we've learned and what we've had to experience, so they don't have to. And
Well, that's the point of this podcast is we want to share as much of that as possible. You know, it's interesting because to me, Warren Buffett, even though he talks about kind of this nominal ideal of of a business owner, he himself is really that nominal ideal. If you look at his writings, and I would highly recommend anybody, if you're a business owner or a private investor out there, read the lessons, no, excuse me, the essays of Warren Buffett, which is a compilation of a lot of his writings from his shareholder letters. That one, interestingly enough, I came across that book many years ago in a corporate finance course, and this is I think one of the real takeaways from studying Warren Buffett's career is it's not about stock picking. I think a lot of people make that mistake. It's really about how to think about businesses. So if you're an executive or a business owner, again, a private investor, you can learn an awful lot. But it really comes down to this normative ideal of business ownership. And going back to what you were saying, you and I read a book, as a lot of business owners have many years ago, called The E-Myth. Author's named Michael Gerber,
mm-hmm.
and that's a book that even today, because it was revised, so we read the E-Myth revisited, but even that revised edition is now decades old. And after all this time, it is still highly recommended by business owners. But what it comes down to is this idea of business owners stepping out of their situation, stepping out of themselves, and thinking about the business distinct of their own day to day. Because what happens is you get caught up in all of these little things, and you just end up on a hamster wheel
Yep.
that you can't get off of. So one of the real takeaways from that book is, look at a company like McDonald's, a lot of that franchise model. So if you were to buy a McDonald's, they hand you everything. They hand you everything soup to nuts about how to run that business. And you should think about your own business that way. Because if you don't, then you're going to be relying on finding the right people. And what do we hear from business owners all the time? I can't get ahead because I can't find the right people.
Mm-hmm.
And it's gotten worse.
Mm-hmm.
So if we go back to COVID, or even a little bit before COVID, labor problems or problems in the workforce, these shortages in the workforce, went from being a pain in the rear end to a real systemic problem. So we saw businesses that were closing down because they couldn't get employees.
Mm-hmm.
That was crazy.
Yep.
I remember Had an uncle who was very successful in business. He passed away a few years ago, but I remember talking to him, and um, and he would share advice and stuff. But I remember talking to him and saying, listen, in the 70s, 80s, and 90s, you never dealt with anything with a labor market this tight. I mean, I don't think there was a single year in his business career where we were really at full employment, right? And
Mm-hmm.
full employment was always kind of defined as about 4% unemployment. I don't think there was a single year in all that where we actually hit full employment. So you have people who have a lot of experience who never dealt with this, but when COVID hit, that whole that whole labor market problem came home in a very big way. And that brings me to something else about business ownership that I wanted to talk about, and that's accountability. Because you and I have talked to a lot of small business owners who, on the one end, they want to make decisions. On the other end, they don't want to take accountability for those
Yeah, yeah,
decisions. And
yeah,
it's an
yeah.
impossible situation. And you
Mm-hmm.
look at that and you say, this is not going to work.
Yeah,
That kind of dynamic, you know, where do you put that accountability? Do you put it on your employees because they can leave? They
yeah,
can go somewhere else. They're not getting the benefit of business ownership.
yep.
So you can't take the upside and the praise, but not accept the responsibility. So
Mm-hmm.
that's another facet, I think, is ownership as accountability.
Mm-hmm.
That's more, that's more in the case of small businesses where you have owner operators, but there has to be, you have to have, it's like that sign that Harry Truman had on his desk where the buck stops with me or the buck stops here. If you're a business owner, you don't really understand that. You might want to rethink, being a business owner. So, do you have any even vague and generic examples of that you've encountered in your career?
Yeah, absolutely. I was going to bring up the main thing. People. One of the things that before I get into that, we talk about fundamentals unfiltered. We talk about our course curriculum. Very easily, some people get that confused with just stock buying. Well, it's not stock buying. Um,
It's how to analyze
it's
companies.
how to analyze companies,
Yeah, and the
right?
stock market is one venue for that.
Yeah, and so right off the bat, all these businesses are started as a small business. It's taken them years to grow up to a publicly traded company, things like that. I mean, you look at McDonald's, right? McDonald's had one of their success stories is because their process was designed perfectly, and they were able to replicate that everywhere. Now,
Yeah, scalability.
yeah, and I'm a part owner of a couple restaurants, and the hardest thing I struggle with is um, making our food taste the same from both locations. And again, it's not from lack of trying, um, but and I agree. There's a book I read by an army guy that talks about how leadership, you have to take responsibility. You have to,
Is that Jocko?
yeah,
Yeah,
exactly.
I
Eh,
really enjoyed his books. He's
yeah,
he's really good.
yeah, and I think that no matter what you do in life, if you're responsible, you have to be a leader that says, okay, this has fallen on me, not on you. I think that also builds your employees' trust with you. And then you learn how to figure out a way to make that work. So it's very, very, very important. Like I said, one location does well, one location does not, and I think it's because we missed the mark with the food prep or the service prep, and um, we've struggled. Again, I'm not. I'm going to take responsibility because even though I'm a minority owner, I'm still an owner. right?
Well, can I interject on that too?
Yeah.
Because I think you're bringing up a good point. One of the recommendations I make to aspiring entrepreneurs is I always say, can you build that business on paper? I mean, literally just soup to nuts. Can you build that in
Mhm.
business on paper, and can you and develop all of these things beforehand? Of course, you can tweak it, but if you're just trying to um, if you're just trying to do it as you go, I mean, you're trying to run alongside a moving train, and it's very hard to do.
Mhm.
Build that business on paper. Try to, and this is one of the things that really separates us as humans from AI is we can envision, we have an imagination. We can envision all those things. We can put ourselves into those scenarios in the kitchen or, from the customer experience or whatever. And we just try to think through all those things. And one of the things that you and I have talked a lot about is business owners, especially when times are good, and this is the paradox because where we live, it's very cyclical, and you have a lot of businesses in the construction industry and in home services, and
Yep.
that can be very cyclical. And when times are good, you have these instances where owners they're doing the best financially, but
Hurting themselves.
they're hurting
Yeah.
themselves long term because they think the good times are always going to continue, and they get complacent about their balance sheet, and they get complacent about trying to build those long term processes. But the other thing is they're not giving themselves time to think. So it's great when you're busy, but if you're not giving yourselves time to think about your business and just get out of the fishbowl, as it
Yep.
were, all sorts of problems can come down the road. So you and I remember very well the 2008 2009 financial crisis, and what was interesting in that scenario and it's about 20 years ago now, because the financial crisis started with a regular cyclical housing slowdown.
Mhm.
And what we were encountering was businesses that were thriving, absolutely thriving during the building boom that preceded it. When that slowdown happened, they got into trouble right away. I'm not
Mhm.
talking about the financial crisis. I'm not talking about, we thought another Great Depression was coming. Just there was a normal cyclical slowdown, and they're just caught with their pants down. And so that's kind of an interesting thing. I will say another thing with accountability is, and this goes down to my experience, whenever people buy a company and they buy especially if they buy their employer's business, so they've been with the business for a long time, they have an opportunity to buy it. A lot of times there is a big shock. So one
Mhm.
of the things that we've seen up front, both you and I, is that you have these employees who convince themselves that, well, I'm already practically running the business, and so
Mhm.
it'll be this easy transition. And when that transition is actually made, they get the financing, and when that transition is actually made, um, they go into that with that mindset. They go into that very complacent, and they find out soon enough that there are all these other responsibilities of business ownership, and all of a sudden it's maybe I wasn't practically running the business.
Yeah.
There's I never did payroll. I never figured out how to move money around,
Yeah.
to pay rent, to do this. And all of a sudden there's those responsibilities, and also again the accountability thing. So if you're like a manager, but you could always just sort of say there's this layer above me, and you could sort of pass the buck, as it were, to that ultimate owner. Uh, that's not accountability,
Yeah.
you know.
Yeah.
So that's a scenario that I've seen. I think you've seen a lot of times as well.
And I think too, some of these lessons that we've learned is the whole point of why we're doing this. To help, you made a perfect point about if the business doesn't work on paper, how many times do we see that people don't even take that beginning step before they go into business?
Yeah, and if I can
And
share a very generic story. Um, I was involved in the business. You were involved in the same business a number of years ago. Um, we had some, let's say, philosophical disagreements with the operator. We got out of that business. What I saw going back, it was a construction related business, and this operator was really insistent on vertical integration. And what that meant was a very high cost structure. And you do not want a high cost structure in a cyclical business.
Mm-hmm.
If you have a high cost structure, a fixed cost structure in a cyclical business, the next downturn you are going to be wiped out, because that acts the same way that debt acts. It's leverage. It makes you look like a genius when times are good. It will wipe you out when times are bad.
Mm-hmm.
And it was a very simple, rudimentary scenario analysis where you could apply to that company. You could see where this person was going to get in trouble.
Mm-hmm.
And that's, in fact, what happened. And sadly, a lot of good people were brought down with it. But sometimes, I mean, I guess that can come down to accountability as well, of somebody saying, I don't want to think about those scenarios. And when they happen, I guess I can just pass the buck. So, Louie, I want to wrap up this, our little deep dive on business ownership, the concept of business ownership. And I want to talk about how many business owners fail to think like owners. Or in other words, they fail to think like this normative ideal of ownership. And I'm going to get back and talk a little bit about my own experience in working with a lot of small business owners and teaching financial management, basic financial management to the small business owners. Because one of the things is that they don't, when you're an owner operator, you have to think about yourself as really two people. You're the same person, but you have to think about yourself as two people. One person is the operator, and then the other person is the capital provider, the shareholder. So I will hold this to the day I die. I hate cash accounting. And probably now's not the time for the tangent on cash accounting, but I will simply say that if you are a small business owner and you're using cash accounting for tax purposes, that is perfectly fine. But you need to have a real balance sheet. You need to have a real income statement. The only way that you're going to do that is to use accrual accounting, preferably generally accepted accounting principles. And I know there are a lot of bookkeepers and a lot of CPAs who don't like that. They think, oh, you can't, small business owners are not sophisticated enough to do that. Well, that's why they need to learn, because here's the deal. With cash accounting, you don't have a balance sheet. You have no balance sheet that tells you what you owe suppliers or what monies are owed to you. And then you go over to the P&L, and you're going to end up with transactions that are out of the period that you're looking at. So let's say you're looking at January with a cash-based profit and loss statement. You're going to end up with transactions from the prior month. You're going to end up with transactions that really should be put into the future month. There's just amalgamation. So you end up with a lot of problems. And if you are thinking like a shareholder, you need good information. And so that's one of the problems. Step number one, when these groups come out and they buy small businesses, that's the first thing they do is they implement generally accepted accounting principles. They move away from cash-based. Again, cash-based can make sense from a tax standpoint. We can go into this in another show, but it can make sense from a tax standpoint, but from a financial reporting standpoint, you need good information. So that's first thing, is you need good financial statements. So you need an accrual-based system that actually shows you that. You also need like key performance indicators that you can follow all the time. So, one of my biggest pet peeves is I'll talk to business owners and you ask them how they're doing just in casual conversation, and they'll say, I don't know. I need to go sit with my CPA. If you don't know how you're doing as a business owner, you need some training. You need some help, right? Because you ought to be able to know very quickly. Maybe you don't know all of the details, but you need to know very quickly if you're making money. And at the end of the day, that's what it comes down to for me. I always say you can have all of the metrics and KPIs, key performance indicators that you want. At the end of the day, business is about two things. It's about discretionary cash flow, or free cash flow, if we want to call it that, and it's about return on invested capital. Right? How much profit am I earning relative to the amount of capital? And you have to have good numbers to be able to do that. So that the whole notion of thinking like an owner, to me, I'll just wrap up. my side of things, thinking like an owner is about thinking like a capital provider, preferably a shareholder, but also a lender too. And when you can get business owner operators to think that way, you can help them make better financial decisions. You can help them make better strategic decisions. And you can put them on their way from taking that business from a job to a real business that is creating real wealth for them and their families. What is your thought about what, I mean, if you had to just come up with to sum this up, what is business? What is that ideal notion of business ownership to you?
So I'm gonna I'm gonna agree with you but disagree with you.
Okay.
So my agreement is, yeah, I agree you need to be two people. But I'm gonna throw this out there because you brought up the E-Myth Revisited.
Mm-hmm.
I actually think you need to be three people. And most people don't really understand that. They need to be the technician.
Okay.
They need to be the manager. And then they need to be the entrepreneur. So how do they, right, whether it's two or three, again, Matt, our differences make this so important because you are very educated, very smart. I take it down to a little bit of the,
Well, I think more of a strategist and analyst.
yeah, where I'm
probably,
more the street
well,
guy or
I'd
the,
say you have more day-to-day operating experience.
yes,
And
yeah. So, and again, either way you look at it, whether it's two or three, how do you make those both people or those three people work as one? Which,
right,
because it's still you. You're that one person.
right.
How do you make all work together to run that business as an owner? And that's what you got to wrap your head around.
And then the other challenge is what you want to do is get to a point where you have a manager in place who is running things day to day,
Mm-hmm.
and you get them to think like owners.
Absolutely.
And a lot of that has to do with incentive structure.
Yeah.
You
Yeah.
know, I mean, you got to give them some of the upside. You got to incentivize them. And that comes back to a little bit to Warren Buffett's definition when he talks about, managers thinking like an owner in the corporate world.
Mm-hmm.
I've been stock investing for a long time and analyzing public companies, and there's a major problem in American capitalism with what we call agency costs. And what that means is that you have corporate managers they have incentive structures that are tied to things like, revenue projections or earnings per share. And those things aren't really value accretive, at least not all the time. And it can
Mm-hmm.
create incentives for managers to just grow the company through, overpriced acquisitions. In a lot of cases, they can manipulate accounting earnings. It's just this kind of short-term focus. So to me, there is an ideal about long-term value creation. And if you can create incentive structures for managers, both in the small business world and at the corporate level, you can enhance the value of companies long term. And again, I would focus long term because I don't want anyone to think that we're looking at companies doing all sorts of illegal things to there's a lot of movies out there about the evil corporations, and that's not what we're talking about.
Yeah.
When a company is thinking long term, they're going to be good citizens in every aspect. And to me, that's what business ownership is. So we'll wrap up the deep dive portion and we will take a break. We will be right back after a quick word from Fundamental Investing Institute. Do you want to become a better investor but aren't sure where to start? With our Foundations of Fundamental Investing course, you will learn the principles behind long-term investing without stock tips, hypes, or trying to predict the market. Learn how to think about stocks as businesses, understand financial statements, evaluate companies, think about valuation, and build a disciplined investing process. Build your investing knowledge from the ground up. Explore fundamental investing foundations from the Fundamental Investing Institute. Start today at fundamentalinvestinginstitute.com/courses. Okay, so we're now getting on the in the news section of our show. And actually, there's really only one thing I want to talk about today because given that it is our first show, we have a little bit of catching up to do. One of the big one of the big events, big macroeconomic events that has happened over the last several months is that back in May we had a new Federal Reserve chairman. This is a man named Kevin Warsh. Kevin Warsh was a Fed governor around the time of the financial crisis, so he's been kind of hardened, and then he went into private life. He spent a lot of time at a think tank, and then he also worked alongside a very famous investor named Stanley Druckenmiller, who was a very famous macro investor who worked alongside George Soros for a time. But Kevin Warsh knows markets, and back when there was a lot of speculation about who the next Fed chair would be, Kevin Warsh was one of the names. He was the name I was rooting for. He was the person I thought would be most qualified for the job. There was a lot of fear in the credit market, in the credit world, that the president was going to name Kevin Hassert as the next Fed chair. And that was really looked down upon because Hassert was thought to be just kind of too compromised politically, just too close to the president. You really want an independent Federal Reserve. I think we're going to probably do a deep dive on that at some point. But for now, what I want to talk about is Kevin Warsh is changing the communication strategy.
So I think that's, again, we're going to go into the Fed a lot more later, but I think the general public's idea of the Fed is hard to wrap around,
Yeah,
and they hide what's going on, and why do they keep it so under wraps?
Yeah, it's not a well understood institution by the general public, and that's created a lot of problems because anytime you kind of have uh, either an information gap, and in this case, it's not even really an information gap. The Fed puts out a lot of information about what they do.
Mhm.
It's just kind of
It's
outside of the
buried
purvey.
of what,
Yeah,
yeah,
it's kind of just outside of the purvey of most people. But
yeah.
so I want to start by trying to put these changes in context, but I'm going to do a little bit of a primer on what the Fed does. Now, they really kind of do two things. One is, which is very, very important, but it's not very romantic, and that is they manage the payment system. So you think about the
Hmm.
plumbing of how money moves around the economy, how money moves from institutions and so forth. The Fed manages that, and that is
Yeah,
really, really important. That's just something we take for granted,
yeah.
So that's a big part of what the Fed does. But the part of what the Fed does that's really kind of in the purview is that they set monetary policy, and they actually have they have a mandate from Congress going back to the 1970s to do two things. One is to maintain price stability, and the other is to promote maximum employment. Now, technically, they have three mandates because they are to maintain price stability, promote maximum employment, and then to promote moderate long-term interest rates. But moderate long-term interest rates kind of falls within the price stability mandate. So, for all intents and purposes, the Fed has what we call a dual mandate: maintain price stability and promote maximum employment. And those two things can be at odds,
Yeah.
right?
So real quick before you get into more, if I don't throw you off,
Yes, sir.
when we talk about price stability, can you, just so our listeners understand,
Yes, and this actually came out this morning. So I think a
wh-
lot of people may be familiar with the Consumer Price Index. So this is the
yeah,
most widely cited. So
and that covers your groceries.
yeah, it's a basket of goods
Okay.
that the government statisticians they do price surveys, and they lump this together into a single price index, so that the consumer price index is the one that gets the most widely reported on. But actually, what the Federal Reserve targets is a slightly different index called the Personal Consumption Expenditure Index, and they're very close. But the Fed actually defines price stability at 2% a year. So they're targeting,
Okay.
they want the price index to increase 2% a year. Now, a lot of people say, well, why 2%? Why not 0%? And I'll explain why that is. There's two reasons. First is that the Fed does not want short-term interest rates, and I need to go back and explain
What are long term and what are short
yeah,
term?
but the Fed's policy rate, which is called the federal funds rate, it's an overnight lending rate. The Fed is very active in short-term money markets. That's kind of the domain in which they operate. The Federal Reserve does not want that policy rate to be near zero. And the reason why they don't want that policy rate to be near zero is because if you get into a recession or a slowdown, they would have no ability to reduce it, right? I mean, they would have to rely on a lot of other tools. And so by having a 2% inflation target, what they want to do is they want to put into interest rates a certain inflation, a certain expectation of what future inflation will be. And that's the point. Lenders always want to be compensated. There's a difference between what are called real interest rates and nominal interest rates, okay? Nominal interest rates, if you went on bankrate.com right now, nominal interest rates, those are the interest rates that you see. Those are the advertised rates. Real interest rates are those rates minus expected inflation. Now, expected inflation is not always an observable variable. There's a couple of ways that you can kind of approximate expected inflation. The first is that the United States Treasury issues Treasury securities that are adjusted for inflation, and then they issue Treasury securities that are not adjusted for inflation. So you could take the interest rate difference of those two things, and that difference is expected inflation.
Gotcha.
The other way you can look at expected inflation is there are surveys, like the New York Federal Reserve, for example, does a survey where they just, go out and survey a bunch of people. And so you kind of get a sense of what people think inflation will be. But anyway, that's very important. So that is, there is an expectation of inflation that is supposed to be baked into interest rates. And the Fed targets 2%, and they try to get markets to, factor in that 2%.
Real quick, when we talk about those interest rates,
Right.
are we talking about, and I know we'll probably go into this deeper in another episode, but are we talking about your normal consumer rates as far as credit cards, car loans, mortgage rates, or are we talking about something different?
So here's the point. The Federal Reserve does not have control over medium-term rates.
Okay.
Okay. The most important rate in the economy, by far, is the rate on the 10-year Treasury yield. That rate today, we're recording this early to mid-August. That rate today is about 4.6%. When a lot of political talking heads talk about, pressuring the Fed to lower short-term rates, they assume that this is going to be this is going to affect mortgages, and it will affect mortgages. It'll probably make mortgage rates go up. The 10-year is what matters. The Fed does not have direct control over the 10-year. Now, this is what comes down to what's called forward guidance. So, go back to Greenspan. You remember Alan Greenspan.
Yeah, I remember
you and I are
Alan.
both old enough to remember Alan Greenspan in the late 90s. Alan Greenspan was very vague in his communication. In fact, he flat out said, if my words had been clear, you misunderstood me. Like they used to call it Fed speak or Greenspan speak, but he very purposely kept things under wraps.
Yeah.
But markets loved him, and he was the maestro. That term maestro, by the way, it goes down to, I think it was in 95, where the Fed was looking at a rate increase, an increase in the federal funds rate. And what Greenspan saw that almost no one else saw was that technology was going to be a huge productivity booster. And if it was a huge productivity booster, that was going to have anti-inflationary effects. So it was kind of like around that call that he gain this almost superstar status, and he became known as the maestro. But anyway, late in his term, he started to embrace the idea of an inflation target, and he started to embrace the idea of using communication and using what they call forward guidance. Forward guidance just means that the Federal Reserve tries to let the market know what they are thinking, because medium-term rates, let's think about it this way. If you and I wanted to put money to work for 10 years, one way that we could do that is we could just buy a 1-year Treasury bill. Mm-hmm. And then when that matured, we'd buy another one. And then when that matured, and we would do that every year over that 10-year period. Mm-hmm. So you can think about longer term rates as a series of expected short-term rates. Mm-hmm. Now, on top of that, you're going to have some risk premium because there's longer term bond markets are a little less liquid, right? There's not as much money sloshing around. And the other reason is there's just more uncertainty over that longer period of time. Yep. So the way that we view longer term rates is expected short term rates plus a risk premium. But here's the important thing. If inflation expectations go up, okay, long term rates are going to go up because lenders, the bottom of this, what we call the risk-free rate, or the lowest rate of return that you can get without undue risk, is to just lend to the U.S. Treasury, mm-hmm. right? So that's always your base rate. Every rate is based on top of that. So if you have a business loan or you have a mortgage, that's all based on the 10-year. Mm-hmm. So that's very important. So if you just arbitrarily said the federal funds rate is going to be 1% tomorrow, and there's an expectation in credit markets that is brought about through political influence, not through data, you're going to increase inflation expectations. And all you're going to get is what we call a wider yield spread. So the spread mm-hmm. between the 10-year and the spread between the short-term interest rates is simply going to go up. So anyway, this was all part of the conversation when Warsh was coming into the chairmanship in May. So when he came in, he said, I don't like forward guidance. His grievance on forward guidance is, number one, the Fed almost never gets it right. And I think he has a good point on that. The Fed has not hit its 2% inflation target. It was undershot for a long time. It was overshot. I think we'll do a show on the 21-22 inflation mm-hmm. and the interest rate shock that came from that. I don't want to go too deeply into that, but I'll just say don't overthink this whole change in communication strategy, because the Fed is constantly changing how they do things. Mm-hmm. And one of the points that I wanted to make is that when you and I were in school, a long time ago, but when we were in school, what the Fed did was very different. And then the financial crisis happened, and they completely changed how they operate. So when we were in school, the big policy tool or the policy mechanism was something called open market operations. So the way this worked is that banks hold money at their Federal Reserve Bank, whatever district mm-hmm. they're in. So you have 12 Federal Reserve banks all across the United States. So we're in Florida, if you have a Florida-based bank, right, that is going to be under the jurisdiction of the Atlanta Federal Reserve. Yep. So if you have a Florida-based bank, that bank holds reserves. Reserves are just a portion of the deposits that they take in that are not lent out. They hold a portion of that at the Atlanta Fed. And all banks throughout the United States do this. So back when we were in school, you had reserve requirements. So you had legal reserve requirement. I think for big banks, it was like 10%. So basically, what happened is you have the reserves that are held at the Federal Reserve Bank are called federal funds. Yep. So some banks would be under the reserve requirements, some banks would be over the reserve requirements. And banks could meet their reserve requirements by borrowing from surplus banks and they would borrow on an overnight basis. That's called the federal funds market. And it's that rate, that's the federal funds rate. That's the rate that the Fed tries to manipulate. Federal Reserve says we're raising rates or not, or leaving rates unchanged. The rate they're talking about is the federal funds rate.
Okay.
They set a target for that.
Yep.
And the way that they get and the way that they try to manipulate. Now, I'm talking about back in our day, because they do things differently. I'll get into that in a minute. But back in our day, the way they did that is they would buy securities from they're called prime dealers. There's a number of institutions that are designated by the New York Federal Reserve as prime dealers. So what they would do is if they wanted to increase bank reserves, they would buy securities from those institutions. If they wanted to decrease bank reserves, they would sell securities.
Gotcha.
And the way they would pay for it, or vice versa, is it was an account. It's a bookkeeping entry. They would pay for purchases by increasing the accounts of these prime institutions. These are huge. These are huge banks, mostly banks. There's huge banks, J.P. Morgan, for example. And they would increase bank reserves or they would decrease bank reserves. So if you increase bank reserves, then you have more funds that can be lent. It's all an indirect mechanism. So a lot of people say, well, the Federal Reserve prints money. They print a specific kind of money called federal funds, Federal Reserve balances, and it's banks themselves that actually create money through the lending process.
Gotcha.
So that may or may not make its way into the economy. But the point is, this is going back to when we were in school. This is what they called zero excess reserves regime. Because when banks would hold money at the Federal Reserve, they did not make any interest. So they didn't want to hold anything more than the minimum, than the bank reserves. So the financial crisis happens. And when the financial crisis happens, what the Federal Reserve does is they engage in, you probably remember, quantitative easing.
Yes.
Right? And
that was a big term.
We don't talk about that a lot. And that's where the Fed kind of became water cooler conversation.
Yep.
What quantitative easing is it is open market operations on steroids. Because normally, when the Fed would do open market operations, they would really just buy short-term Treasury bills.
Okay.
When they engaged in open market operations, they were buying virtually any asset. It had to be high quality, but they were buying longer-term Treasuries, they were buying mortgage-backed debt, etc. But the point is that they flooded the banking system with reserves. Now, normally that would be inflationary. The reason it was not, there were two reasons. Number one, banks were very hesitant to lend because they were just, they were burned by so many bad mortgages. But the reason why it was not inflationary is that there was a new policy tool given to the Federal Reserve around the time of the financial crisis. They were allowed to pay interest on reserves.
Okay.
So what the Fed said is, they can keep reserves out of the hands of the lending public by paying money on these reserves and creating an incentive for, banks to. So that became, over time, they said, we're going to keep reserves very high in the banking system, right? So reserve requirements became a thing of the past because you move to what's called an excess reserves regime. So they're paying money on these reserves. And that became, instead of open market operations where they're manipulating the supply of bank reserves, this interest rate that they pay on bank reserves, that became like their key policy tool. They still target the federal funds rate and the federal funds market, but they do so through a different mechanism. Anyway, I don't think that is all that important, but I think it's some important background. But where Warsh has changed things is he said they used to use forward guidance. This became very big when Ben Bernanke was Fed chair. And the reason they used forward guidance back then is they were trying to bring down long-term rates.
Yep. Again,
they don't have full control over that. But at the time, inflation and inflation expectations were so low that you had near zero interest rates, and you're trying to bring the 10-year. You got to remember, a couple of years ago, what was the 10-year? 1.25? I mean, it was well under 2%. I think at some point it was under 1%.
Yeah.
Right? So what's different? Inflation expectations are higher. So that brings us to this morning. we had a CPI number that came out, I think, about 3.7. So inflation is running over the Fed's 2% target.
Yep. Yep.
And that's the big question. Now, interestingly, 3.7 is a little bit below what it was last month.
Yep.
So now, if you read the news this morning, what they're saying is the Fed's probably going to hold steady at their next meeting.
Yep.
And that's a big change because they thought the Fed was going to increase rates. Now, what does this matter to you? It depends where you are, because you and I spent time in and adjacent to the real estate world.
Mm-hmm.
And in that world, interest rates matter a great deal. A lot of your debt is variable.
Yep.
So you care about these interest rate fluctuations. But if you're a mainstream business somewhere, it could influence consumer behavior, certainly influence your borrowing costs. I mean, it does have real ramifications, but what I would not do is expect those zero interest rates of the post-crisis period to come back anytime soon. And I'm amazed when I still talk to people now who think that this can somehow be brought about, either through political means or otherwise.
Well,
that's not the way it works.
No, and you've definitely spoke about this a lot. Historically, our rates are very low. They're higher than some of us remember.
Yeah, they're at historic norms.
Yes,
or closer to historic norms.
Yeah.
You're absolutely right, and that's what's kind of amazing, because you and I remember 7% 30-year mortgage. It was 8% 30-year mortgage. That was normal.
Yeah, and even a generation before us, this 1970s, the rates were like 17%.
Well, we'll do a show on that, because as you know, I'm a financial history buff, and the 70s are in change in monetary policy is very interesting. Let me give a shameless plug on this, because I know it's a complicated concept. On our website, you can go to fiilearn.com. We have a blog series on the Federal Reserve, and then by the time this podcast goes out, I should have an ebook out there. It's going to be very low priced, but we have kind of the free version of that on the blog series, but then we'll have an ebook that is going to explain in layman's terms what the Fed does, a little bit about the Fed's history, how banks create money. It's a money and banking textbook, but as much as I try to give a little bit of a primer here, it's hard to do via podcast.
Yeah.
I just wanted to make the point, but going back to the Fed's strategy with Kevin Warsh, yes, he's moving away from forward guidance, but the point I would make to people is that the Fed is constantly reviewing how they do things. So back in 2020, and this was a major mistake, but they said, we're going to let inflation run hotter longer. And that really gave them a bad framework going into the post-pandemic inflation, which again, we'll talk about in another podcast. But overall, I will say I like Kevin Warsh. You have this little experiment in communications. We'll see how that pans out. There are arguments on both sides of it, and I was hoping to get into that a little bit more today, but I really just wanted to give some background to what the Fed does, and I to kind of start to wrap this up, really want to make the point that if you're a business owner or a consumer or whatever, I mean, those base rates that concern you, the Federal Reserve does not control those.
Yeah.
And there's so much information that goes out from, a lot of politically minded people who just don't know what they're talking about. And that's not exclusive to today. I remember going back to the crisis and after the crisis, when the Fed was, it became water cooler conversation. And a lot of the information people were getting was from, conventional news sources, highly partisan news sources that were just wrong.
Yeah.
And so, that's something that we'll talk about more another time. But
Well, I think he's in uh, a unique situation, so he needs to do the right thing. I think very confident that you know, some of us that grew up in the 80s and 90s and
God,
early 2000s, listened to Jay-Z, and Jay-Z had a song that said,
jeez.
men lie, women lie, but numbers don't. And I think that's the hardest understanding about Kevin Warsh's job is he's looking at the numbers
Yeah,
and
data
needs,
data dependence, as they call it. Yeah.
yeah. And that's what really, it's hard to get away from those feelings. But when the numbers aren't there, there's no reason to drop the rate or no reason to raise the rate. So and I think that's very important with his job. And I think he has, that communication strategy, hopefully that he can get that message out to us.
So let's talk about what's in the works here, because there's something I'm really excited about. We talked about doing a series on the death of malls,
All right.
and we're going to do this whole thing about going back to our childhood and how important malls were, and really talk about why. Do a deep dive as to why that is, and that's probably going to take a few podcasts to really do. But we're trying to schedule, you and I, we're trying to schedule a little field trip to our local mall. This is the mall that we went to when we were growing up,
Mm-hmm.
and I think it's going to be. I don't know. It's interesting. I'm interested to see what kind of emotions come up just being there.
Yeah. Especially walking around, see the stores, what stores made it, what stores didn't, how we remember.
When we look at this as a case study, that's what we're really going to do a deep dive on. Is that hypothesis accurate? I don't think. I think it's way too much of an oversimplification to say that this is just online retailing, and that's, we're going to look at these. Why did KB Toys not survive? Could they have survived?
Mm-hmm.
Walden Books. I mean, there's quite a few. We're not going to be able to talk about all of them because, frankly, the number of stores that have just that have gone away with malls, as malls declined, and in many markets they're non-existent. We want to know. Could these businesses have survived, because they're still brick and mortar retail?
Yep.
I mean, it's not like we live in a society where there is no brick and mortar retail. They're everywhere. So I think that's what we're going to be doing, a little bit of a deep dive. What I want to do is to kind of open that series with just some historical background about malls in general, and then we're going to talk a lot about our own experiences and what we can remember, and then we'll start doing case studies on individual companies. But with that, I want to thank everybody for listening. Lou, thanks for being here.
Love it.
We've been talking about doing this podcast for a long time, and everybody and their mother is doing a podcast, and we said, you know what? Why not us?
Yeah,
We're
why
just
not?
as good as they are.
And this is our first time, so as we get more comfortable, we'll keep adding things and keep learning from our how we can keep you guys entertained. But I think it's very fun and informational.
Yeah, so we'll keep at this every week, and hopefully, there's a lot of information and education that we're putting out there. So thanks for listening. Please go to fiilearn.com. You can explore fundamental investing foundations, and you can explore other course material. Again, that is fiilearn.com.